Morning.
Come. Good morning. The topic today is the sky is not falling, which is, considering an economy that's grown from $1 trillion to 11.5 trillion in a decade and a half, is an interesting topic. China, in my opinion, is not a developing market, as it's often called. But having said that, there's a number of issues that have come up, particularly in the Western press, to think about and ponder, because as the second largest economy in the world, it matters to all of us and every economy in the world. So since we're up against Kobe Bryant, we do appreciate all the attendance this morning. And so there's definitely some people still interested in things other than basketball. But since James is here and used to set up the NBA in China, which has more viewers in China watching the NBA than in this country, I thought we'd just start with the NBA.
Sure, some trivia for you. Like, the #1 jersey sales in China is still Kobe's jersey. So, and I was talking to Commissioner Stern yesterday, and he assured me there won't be more than 5 people in the panel in this room today. So I'm glad that we're able to exceed that expectation.
Yeah. And maybe just stay on the content side in China, because that's been at DreamWorks something you've been very focused on, obviously.
Yeah, so what we've been so China is going through some amazing growth in the film market. 2015, I think, is an explosive year. When we closed the year in 2015, the total box office in China is around $7 billion. That's about 70% of the U.S. market. In the first quarter alone this year, the box office was $2.1 billion. So just to give you some context, the box office in China in 2010 was about $1.6 billion. So to give you an idea that in 56 days in the first year of 2016, we exceeded the entire box office for the year of 2010. So this market in the film is growing exponentially, and we expect to continue to grow. And most of the film is driven by screens, so the number of movie screens in China. There's about 31,600 screens in China versus around 43,600 in the US. Give you some rough comparison. So in the US, there are about 122 movie screens per million people. In China, that's around 24. So you can see that the headroom that you can grow. Americans love our movies. We love our movies. Just a regional comparison, China's neighbor, Korea, has around 44 screens per million people. So the growth in China for film will sustain for at least a couple years. The general consensus is that China's film market will equal the US film market size, around $10 billion by the end of this year or very early next year.
And it's interesting. I think ticket price in China in many theaters is higher per ticket than the US in dollar terms.
That's a misnomer in the sense that those are listed prices. Yeah. So 80% of the people in China purchase their tickets on their mobile phones or some kind of a mobile device. And through those mobile devices, they're able to get discount tickets at probably 30 to 60% off, depends on the promotion that's promoted at the time. So the comparison, so in the US, through online ticketing, that's around 12 to 15%.
I'm going to come back to the online world in a minute with Neil, but I'm going to pivot here to Jing, and who spent some time talking to a number of multinational and other clients of JP Morgan around the world about views of China. So let's have a quick rundown of that, and then we'll move on to new economy.
Okay, great. The world is so fixated about China, Tim. I think with good reason, because China is contributing 35% to global growth. As you said, Tim, GDP is $11 trillion today. So if it's growing 6% or 7%, it is adding about $700 billion to global growth every single year. How big is $700 billion? Basically, that's the size of the economy of Holland. So every year, China is adding a Holland to global growth. Without China, global growth obviously will be much lower. So as I travel around meeting with our clients among multinational companies and global investors, their sentiment seems to be changing. Second half of 2015 was very negative because there was lack of communication on the part of the leadership. There was a devaluation of the Chinese RMB. There was also a crash in the Chinese stock market. But since February, I've sensed there is a subtle sentiment shift. The outside world is no longer as negative as it was towards China, because the economy seems to be stabilizing. Also, one could question where the growth is coming from. Of course, we have a lot of debt pile up, but we are seeing a recovery in the housing market. We're seeing the new economy zooming ahead. I'm often asked by clients, are you expecting a hard landing or a soft landing? So it's very hard to say. I say, well, in some of the sectors in the Chinese economy, i.e. the new economy, entertainment, travel, the internet, consumption, it is not landing. It's going very well. It's growing probably 20%. But in the traditional sectors, i.e. the old economy, it is probably going to experience a crash landing. One last point. A few years ago, the Chinese Premier Li Keqiang devised an index to gauge how strong or how weak the Chinese economy is. So this has come to be known as the Li Keqiang Index. 3 things in the index. Number 1, power consumption growth. Number 2, rail freight volume. Number 3, bank lending. So if you look at the Li Keqiang Index, actually, it is not growing, it is contracting because the heavy industries are really suffering. So, Tim, I hereby propose a Jing index. Jing is my name. So, if you look at the new economy sectors, if you look at movie theater box office numbers, if you look at domestic travel, international travel, consumption growth, the service industry, in fact, the Jing index is growing probably between 15 and 20%. So it is a story of 2 economies, between the old and the new. As investors in the audience, I think it's very clear where you choose to invest.
And we will talk about the debt situation. Mr. Xiao is going to talk about it in a minute. But Neil Shen on my right, now just call up slide 11, which is a bit of a graphic, euphemistic slide on BAT, Baidu, Alibaba, Tencent. Neil, one of the most interesting things about Sequoia, which China, which is run by Neil, started not too long ago. Sequoia has more people in China than they do in California, which says a lot. But Neil has really been at the heart of a lot of this. But let's dig into the new economy a bit as an investor and as a business builder, Neil, because you were an entrepreneur before.
Thank you, Tim. I think if you're looking at obviously these 3 companies, most of the U.S. investors are very familiar with them. But these just obviously the very top representative of the whole new economy in China. There are a lot of companies, smaller compared with their these, but also I think being high growth and high value companies. I think it's very important to put in perspective what is happen to make those new economy companies doing so well. I think at least there are 3 major factors. One, I think we have to admit that there is a very strong entrepreneurship among in the private sectors, especially the younger generations. And you need entrepreneur to drive those companies' growth. And this is really a key attribute to how the private sector has been doing very well. Secondly, you have a big market, especially consumer market. If you look at Alibaba, without a huge domestic retail market, e-commerce company like this size cannot be built. And same is true for Tencent and Baidu, and for many other new economy companies. And thirdly, their technology. And China do have, I think, world-class technology. Most of these 3 companies probably enjoy their market position because of technology applications. But we are seeing a growing number of companies which really has a world-class technology and product. For example, DJI, which is a Shenzhen-based drone company, occupy more than 60% of market share in the commercial drone market. And BGI, another Shenzhen-based company, which is a market leader in gene sequencing, analytics business in a global base, enjoy clientele from very top hospitals and medical research institute, from Europe and from US. So, and this is one big edge of China because we got a very strong undergrad and advanced study research. We get strong universities and academic research institute, and those are the really lay down the good foundation for those talent who came out of those college, right? Look at how many people Huawei and Tencent and Baidu and Alibaba has hired in their engineering team. I mean, and China has the ability to, able to come up, with this, talent pool. And obviously, on top of these three, I see where, we sell, generally a pretty favorable regulatory environment towards new economy, whether it's drug, discovery companies applying for SFDA approval, or in general, the attitude toward e-commerce company and other, internet companies. I think these combinations has really, the main drivers, behind the scenes. So now we see those companies came out of global stage and become very substantial companies.
But staying on the Chinese characteristics, the unique Chinese characteristics of these companies, you don't see Google, Facebook penetrating like they have everywhere else in the world. Maybe talk a little bit about the reasons for that and how you see that developing.
Yeah, I think
these are oligopolies at this point.
That's right. I think the Chinese company tend to expand their business scope as they grow. For example, Baidu was all about search, back 5-6 years ago, but now obviously they expand into O2O services, they got into videos. Tencent come out of its communication tools, now get into other related business, for example, online medias. And Alibaba, they get into movies, entertainment, healthcare. And I think because once you have the ability to acquire customer online, they just have the big edge, actually extend their reach to offline. And this is a very unique phenomenon. Think about it. In US, we got PayPal. And we obviously, on the physical offline world, we got MasterCard and Visa and American Express. But PayPal never tried to shake up that market. You never seen a restaurant here that you say, hey, why don't you use PayPal, right? But in China, who is disrupt the offline payment market? It's Tenpay and Alipay. And they're so big, they already occupy the customer, they can extend their reach to offline. So when you go to Park Hyatt in Beijing, when you try to pay your breakfast, you have the alternative. Instead of paying MasterCard and Visa, you can pay through your mobile phone, your Tenpay and Alipay. That's the unique edge of the online asset in China, which can extend it dramatically into many of the offline businesses.
Interesting. Thank you. So, Mr. Xiao, you get to answer the hard question. So if I could just throw up slide 12 for a minute. And ICBC is the largest bank in the world by market cap. And on slide 12, which basically shows, and this is the Chinese banking system, which has more than tripled in banking assets in the last couple of years. And by Chinese numbers, there were some statistics shown that said all lending, social lending, because lending between individuals has always been a big part of the culture of China for many years before there was established banking system, plus the formal system is growing at numbers like 4% of GDP per month. And while 250% of GDP, or whatever the number is today, is not off the charts in terms of a developing market, the rate of change is very dramatic, and we saw today that bond spreads widened dramatically in China. So maybe you can take us under the hood a little bit and talk a bit about, is this a problem? And where is the moral hazard? And is it SOE lending? What's the structure of it? How do you look at it?
Yeah, thank you. So actually the question was two-part. In the coming months, there's rising concerns about China, about the high leverage on the bond market issuance. And the other thing was about the NPL, that's the credit environment over there is okay or not. So the first question Tim has raised actually, so we had this kind of fast growth lending in this couple of years. So where those investments focus on, and how it's combined. That's the quality of those investments, and actually do we concerns about a little bit leverage level of those investments. So to me personally, I think the leverage in certain sector is still pretty low. It's not good enough. And in some certain area, the leverage has already been high. So that's actually the structural program that the Chinese government is leading, trying to serve. We call it the leverage, the storage, or everything. So Jingyan, Neil mentioned very good things about the new economic growth in China. So the current issuance of the debt with the new increase of the debt, so basically was more focused on the new areas, new economic, compared to traditionally more in the the overcapacity like steel or production manufacturing. So we think that that's a very good direction for what we land on to the different sectors, and more diversified, more healthy, more focused on the consumer-based consumptions and compared to what we had before. So it's currently a little bit pressure from the restructuring, but I think the direction is pretty good, and we have the pretty clear strategy head on that direction. So the second thing was about NPL. What's about the quality of those investments and how we control the asset quality growth in the future. So currently, I believe there's a certain pressure on the asset quality for a couple of years more, because during this deleverage area to some traditional sector, like overcapacity sector, definitely there's some pain in it, and they need to spend some money on it. And the other thing, we see some good signs over there is, for example, the credit environment had been a lot better compared to what we had, decades ago, because in China, the information, the transparency on the information, the credit environment is not so good. Currently, that we basically, for example, I take ICBC like example, that we have accumulated like a few decades of the information for all the creditors, for all the individuals over there. So we found the improvement of those transparency in the social society will definitely help to improve the quality of your lending. That's a very important thing that the big data can do, can help us. Then the second thing that we show is a good example is the shift from debt to equity, or the shift from the bond to equity to loan. It's not very simply, from your left pocket to the right pocket. It's actually a change of the structure. So to the different area and the different sectors. In this first quarter, the most of the lending was more invested into the consumption sector, rural area, infrastructure, and some new investment hub over there. So I think those were the direction we want to go in the future. So the other thing is also that helped me feel pretty comfortable with the growth of China for the quality is the earning capability for those banking system and non-banking system is still good. Basically, take ICBC like example that we had net profit in last year was 277 billion RMB in last year. And basically, it's a total amount of the past 5 years total net profit, so it still grows. So that's a very key point to solve the quality problem, because as long as you can grow, that you can basically bearing the pains and take the right direction to go. So I think that were the points we had.
I still think this rate of change is going to be a meaningful problem. I think bond defaults are going to be a healthy thing for the bond market in China. Keep in mind that foreigners don't really participate in the bond market in China. Only 2% foreign participation in the domestic bond market in China. So there's not a high contagion effect. It is the third largest bond market in the world today. But I do think that there is going to be challenges here, and it will have the potential of affecting bank balance sheets meaningfully. Fortunately, they're highly profitable institutions if they don't get completely intermediated by Alibaba and the online non-bricks and mortar assets, which is something we can go back to. But I'm going to unleash the bull on the left. And when I first moved to Hong Kong in '95, Stephen wrote Maximum Bullish, and he made the call on the breakout of China in the market, and he was a lone voice back then. So let's see what the tune is today in terms of this new normal, because we're in a different phase today, Stephen.
Well, we are, Tim, but there's a lot of discussion so far on the stage about exciting new companies and concepts and going to the movies. And I think this is all part and parcel of this big shift that's going on in China back from the days when we first started going there as prospectors. China did what no large developing economy has ever done for 30 years as a producer. And now it's doing something that no large economy has ever done. It's reinventing itself as a consumer. You may think, oh, it's easy to do. Try it someday with an economy the size of any major developed economy in the world. The problem for China in making the transition is well known, whether it's misallocation of scarce resources, loan quality, market disruptions, you name it. The question that we have to address, though, in a panel like this is, are these problems bumps in the road, or are they really a sort of a Wile E. Coyote type of an outcome where the little animal just goes right off the cliff and implodes? I think it's more the former than the latter, but I grant that there's a lot of challenges to reinvent yourself after having been a producer into a consumer, because after all, the producer model is one that plays right into the sweet spot of the central planners. They can engineer production, distribution, mobilize resources, not caring a whole lot about whether or not the goods are sold or not, piling up as inventory. They get paid on production and employment. And so now to tell them to think about the need to get middle-class consumers to change their behavioral norms, from fear-driven savers to aggressive, confident consumers, that's getting right into the DNA of human psychology. Central planners, they have a lot of strengths, but understanding the DNA of the human being is not one of them. So they've got to relax and let consumers really behave in a way that's consistent with a more confident perception of the future. And they've got to do things to provide that confidence, like a secure social safety net, healthcare, pensions.
Let's just make the note that Holland at least has a pension system.
Yeah, in Holland, God bless them, they that's probably all they have today. So, China is having, I think, some issues in learning how to reinvent itself as a consumer.
You've watched the politics in China very carefully over the years, because back to Premier Zhu and the amazing transformation that happened when China opened up, and we have a very strong, very powerful leadership today in China, whether you like it or not. But how do you looking at the current plan and the reform that's going on from a political, economic standpoint?
Well, the next election probably won't be as close as the one here, but they is a one-party system. They deal with politics in a different dimension. I think the most controversial aspect, Tim, of their current political campaign is the anti-corruption efforts. And this has caused a lot of consternation both inside and outside of China. But go back again to the core thesis of the consumer society, the consumer that needs to act with confidence toward the future. Without confidence in the institutions that define that future, the consumer is going to continue to save, and the economy is going to get stuck. And so I would argue that while there may be a lot of different ways to slice and dice the anti-corruption campaign, to the extent that this effort can be directed at really underscoring the confidence that Chinese families have in the institutions that will provide for their security in the future, this is a very positive, albeit painful, transition for China to get through. The politics, I think, you can get into the South China Sea, these are issues that I certainly have concerns about, or the East China Sea. But the anti-corruption campaign is being vilified by the hypocrites in the West who've always asked China to deal with its corruption. And they're doing it in a way that I think will be an important foundational development for this greater sense of security in the future.
Let's just play, and I'll ask Jing and you, Stephen, as well. On slide 15, this is a bit of an eye chart, but
it's like my cardiogram.
It is. Well, you're still alive. That's the good news. But one of the things when you looked at, and particularly when the renminbi was entering the SDR, these minor moves in the renminbi, last year, it was awkward for the public stock markets globally. And I think one of the major concerns from financial markets, you have a currency that is, on any measure, 15%, 12-15% overvalued. A major correction in the renminbi rate would be very difficult, A, for its neighbors, and B, for the financial markets. And fortunately, it's been a bit of a closed system, but there's a lot of outbound corporate M&A activity. There's a lot of more complicated capital flows.
Absolutely.
And JP Morgan, obviously a major participant in the foreign exchange markets. Maybe just comment on what's happened in the renminbi and what should we expect and what's the effect on all the markets we're dealing with around the world. And just as a side note, I took this poll when the Japanese went to negative interest rates. Not one person would have said that it'll be the strongest currency after the US dollar in the world, and it is. So they're incredibly hard to predict. But maybe ask you and then Stephen to comment on back, and then I'll come back over here.
So 3 points to make on the Chinese currency. Number one, investors out there are beginning to get away from the bilateral relationship between the US dollar and the Chinese yuan. We all need to get used to the new reference, which is a basket of 13 currencies. So the Chinese leadership announced this basket in December 4th of 2015. But prior to that, everyone has been looking at the dollar RMB exchange rate, just a bilateral relationship. We need to get used to this new reference. So the new reference rate is very widely available, CFETS. You can look at where the RMB is trading every minute. So in fact, the Chinese leadership is trying to manage the Chinese yuan against the trade-weighted basket. In fact, since December, it has been very stable, trading between 99 and 101. Now, so that's one point to note. Secondly, the Chinese yuan eventually will be freely convertible, perhaps sooner than people expect, maybe in the next 5 years. But here, I want to caution everyone. The central bank governor in China said the capital account convertibility in China is going to be not based on the traditional concept of being full or freely convertible. China will adopt a concept of managed convertibility. So sometime in the next 3 to 5 years, the Chinese yuan will be much more liberalized. Therefore, perhaps it's going to be freely tradable on the capital account as well as the current account. So that's something we can all look forward to, therefore leading to more free...
That's good for property prices.
Good for property prices, more outbound investments from China. China is already an exporter of capital. Of course, it is still a very large exporter of goods, but China has indeed become a net exporter of capital. Second point to note here is there's a concept of the impossible trinity, right? It's a trilemma faced by governments and central banks around the world. The trilemma basically is that a central bank or a country cannot achieve 3 things all simultaneously. The 3 things are fixed exchange rate, free capital inflows and outflows, and free monetary policy. So you have to choose one of the three. So I think China is now on a path to achieve more liberalization of the Chinese currency. But this is going to happen one step at a time, very slowly, steadily, rather than happening very abruptly. And the last point to note is that who determines the value of the Chinese yuan? Not the foreign investors. Basically, I think the value of the Chinese exchange rate hinges on domestic confidence. What the 1.3 billion Chinese people do with their vast savings. China has the largest savings pool in the whole world, amounting to 21 trillion US dollars.
If the currency were convertible today, what would Chinese do?
I doubt a lot of them will convert all their RMB into foreign currency.
I'll take the other side of that.
Yeah,
Stephen?
right, sure. It's a very interesting point. For RMB, so I have actually two items and the category with Jing in that point too. I also say it in the group of RMB working group here in the United States. So we have done a lot of research that how United States enterprises and individuals value RMB and what's their expected RMB. To me, quite surprised they were pretty welcome because the settlement in RMB or settlement in other currencies was definitely going to help the trading volume. Give an example like I was in Japan start from 2004 until 2010. And when I was in Japan, Japanese yen to US dollar was 131 to $1. And when I left, it was basically it's 90 Japanese yen to $1. So you think about do the math, it's only 6 years. Every year, if the trader did not do the hedge upon that, nobody can really win the game, right? So the kind of the diversification upon the trading currency was definitely good. And stability of the RMB will definitely help the bilateral trade between US and China, as well as the world trade volume. And the second point I want to add on is the RMB. What we want to pay more attention is to FDI investment in the regional area of Asia in RMB. So in recent years, the faster growth of RMB settlements in global trade has been a little bit slower compared to what we had before. In a couple of years ago was like 40% a year, 50% a year. Last year probably is around 10% growth in the trading. But the FDI in RMB in regional grows so fast that every year keep the average in 5-year coupon rate in average probably is 56% every year in the area. So I think that really shows the capability and the welcome to the market for the RMB as a settlement and the investment currency.
But Tim, you're right to raise this because the topic here of the session is the sky is not falling, and yet this slide. That blue vertical bar in January 2016 was a period when the hot money really drove the perception that the sky was falling. And there was a lot of ink in the media and certainly a lot of strong arguments being made by very well-known Western investors whose names I will not mention, none of whom who have been invited to this conference, though, who were arguing that China was displaying the manifestations of a classic emerging markets debt and currency crisis, the likes of which brought down most, but not all of Asia in the late 1990s. The sky did not fall. And the reason the sky did not fall is that China is adept at dealing with both structural and cyclical issues. It can walk and chew gum at the same time, and it's got the wherewithal to do it in terms of the reservoir of saving that Jing just indicated. Yes, there's been a lot of capital flight out of China, but still with foreign exchange reserves now stabilizing at around $3.25 trillion, well in excess of what any country has had or needs, China has the wherewithal to hold the line and to still manage its economy both cyclically and structurally in a way that can create a big floor under the currency. And
Slide 20.
the core strategy of China, consumer-led rebalancing, forces China to think more about the role that a strong currency plays in that transition. Its sharp reduction in its current account surplus certainly puts a fundamental floor on the currency. And the governor of the PBOC, Zhou Xiaoshuan, stood up and indicated that China is perfectly prepared to use its ample firepower to support the currency, and the sky did not fall.
Good.
You know, it's
I want to
interesting.
go over to the real economy for a second. Got the macro guys on this side. So on, and we have about 20 minutes left. We will take some questions at the end if people have them. I can't see who has a question, but we'll last 5 or 10 minutes. We can do some Q&A. But I'll start with James. Non-tariff trade barriers. We have a trade agreement with China post-WTO, which is an enormously important move globally for China, the US, and other markets. But in terms of operating offshore into China, maybe just share some of your experiences, the good news and the frustrations that executives have, particularly around content.
Right. So China's an interesting place if you want to do cross-border. So when I was at Amazon, we did a lot of cross-border trade. So one of the biggest businesses on Amazon in China is actually cross-border, especially the things going out. Amazon has one of the largest online platform for Chinese suppliers to directly go out and reach out to Chinese U.S. consumers or global consumers in the U.S., a B2C platform model. To move goods and capital out from China to the U.S. is really easy. Matter of fact, the infrastructure is there, the policy is there, it actually gets really quick. About a year and a half ago, 2 years ago, China went through this huge growth in something called haitao. What haitao means is I want to bring high quality foreign goods into China. That's when we found we had a lot of problems actually when you do these cross-border trades of trying to bring things into China in terms of how do you manage the custom logistics? Because China's infrastructure has always been facilitating things going out. And things coming in, that's a new phenomenon. The customs and the duties, they weren't expected to handle all of that. They didn't know how to go do that. How do you do the foreign exchange concept? So unlike, they're very used to doing bulk shipments coming in. What they're not used to in terms of the cross-border is personal consumption transactions. The customs couldn't figure out how to go do that. So we had to actually work with the Shanghai Free Trade Zone, the Tianjin Free Trade Zones, to set up very specialized programs with the customs, with the banks, and so on and so forth, so we can actually take bulks of containers of stuff, moving them, pre-position them in China, and then clearing custom one at a time, and then be able to work out a new custom clearing system where we can actually clear custom once every 2 weeks or once every month, depends on the volume, rather than clearing each item, if you can imagine, one pen at a time as we're doing these transactions. So that's something that I think that the regulatory hasn't caught up yet.
And do you feel your intellectual property is secure?
I think it's getting a lot better. So I used to work for a company called Microsoft. So back in 2002, I was running the Windows business. My total annual revenue was like 14 million. And the piracy rate of some of the largest PC producers in China was like on the order of 97%. So it's obviously have gotten tremendously better, especially in content. The reason why content is getting a lot better is because people are moving to a streaming model as opposed to a DVD model. So I think there's some aspect of that where there is some opportunity for monetization. The problem is right now is the content value is significantly lower than that in the United States. So for example, Netflix will pay up to maybe $1 million per episode for a typical animation show. In China, it would not come even close to that particular amount.
Do you think we'll see a Netflix emerge in China, equivalent?
There already are similar equivalents in China.
But it won't be a winner-take-all, you don't think?
Hard to say, because right now the OTT model in China, and Neil can address some of that too as well, because we're both operating and look at the same space, went through a pretty big shuffle. It was pretty liberal in the, about a year and a half ago. You have the Xiaomi's of the world, you got Little TV, all trying to get into the OTT, over-the-top set-top boxes, into the consumer space, driving subscription model, driving content. And then the government changed the regulation and reshuffled the licenses. So right now, there's only 7 people that have these OTT licenses, and they're none of the new economy guys. They're very much more into the traditional broadcasting type of people. So that creates an interesting new operating condition that we haven't faced before.
Right. So Neil, let's take some time on this, and maybe let's pull up slide number 8. Lucky number. New economy, old economy. Alibaba, largest deposit-taking institution in the world. You know, what does that do to ICBC? And so what's the consumer? The consumer patterns are so different. You know, with this lost generation, as they call it. I can't remember the Chinese name for it. So maybe just spend some time as you approach the market and this booming new economy, and also reflect a little bit on, you know, what it means in the society. Obviously, the SOE sector and the old economy, more centrally planned, and you know, how is this shift affecting things? And
sure, I think this actually just fall on what I've been just mentioned in the early discussion. So I think one of the reasons why the Chinese online space is so advanced and robust, one of the reasons is actually the offline sectors, many offline sectors actually are relatively underdeveloped, right? If you look at it, retail space in US well developed. So that's why online obviously has a decent penetration, but a good part of the retail still goes offline. In China, the offline the offline retail is actually going through a upgrade. At the same time, e-commerce emerged, and e-commerce is able to take a very large market share. Same for financial services, because many financial service areas are not well addressed as yet. Obviously, ICBC did a wonderful job, but there's still a lot of room left. For example, the Chinese credit card market is very small, right? I mean, some people, ask me like whether there's opportunity for subprime. I say, well, not subprime, yet. I mean, some of those, very good customer has not been offered a credit card as yet. If you look at consumer, credit market in general, that's very true. If you look at asset management, also very true. So that's why I think company like Alibaba, with a strength in its customer base and its online brand, could leverage Alipay and move into the financial service, pretty aggressively.
How many customers today,
Alipay? I don't know the the recent number. I would imagine that's over 500 million, for sure. And so is Tencent, right? And so is Baidu. So I think there's a lot of missing pieces, the offline financial service world. So these actually are being filled in by the online players. And for example, many of those younger generation professionals cannot really get in consumer credit through the traditional banking channels. They're too small. It's a market the banks probably do not have the bandwidth to address it. And then online internet finance, as we call it, has really able to take over that role from the financial the major offline financial service companies, which I think it's a very good way to actually to addressing the needs from the consumer market.
But isn't there one other thing, Neil, that is so important? Not only does China have the largest online community in the world, but I think the numbers show that about 44% of the internet users are millennials, non-conforming young people who are, technologically savvy, globally aware, disrespectful of all the old habits that people like us on this stage have, and they're really willing to take a flyer on this new economy and the new goods and services platforms that are available to them. And the idea, I mean, there's been survey data that has looked at millennials in the developed world, like this country. You know, they don't save. And there's this notion that Chinese people are programmed from day one to always save. I would put to you that the combination of you know, their demographic cohort, the new platforms that we've described, they could be pretty surprising in stepping up as active consumers in a short period of time.
Sure, and I think, you know, coming back to this new economy versus old economy, many of those old economy companies has been mostly, dominated by SOEs because, you know, they got a license, they got the, you know, long history, they got a brand, and they're able to, you know, serve this, you know, existing customer. But you know, if you look at the new economies, mostly actually are private companies, and they're able to actually taking, market share away because of, again, a targeted customer, maybe younger generation, the millennials, use better technology, use online versus more like offline. So I think, you know, you're really seeing they have a little bit of, different roles of responsibility in how to grow the, the economy. But I do want to point out, because, touching to, James' point, there are arguments in China whether there is a 国进民退 or 民进国退, meaning whether it's the SOEs, the old economy is taking more market share now, or it's actually the private sector taking more market share away. I think it's debatable. But one thing is pretty sure, in the last 10 years, it's the local company taking more market share. And the foreign company, unfortunately, James, you got James?
We're a hybrid.
Yeah, hybrid. So the foreign company is actually reduces market share, for sure. And I think, and for foreign companies, so to speak, like, to some extent, you guys are part of it, you have to leverage your strengths. Like you mentioned, Amazon. Amazon is not a big player in local e-commerce space, but you guys are focusing on trades between China and offshore. And that's the right way to do it, because that's where all your strengths to come from. If you want to get in the local battlefield with JD, you don't have a chance. So I think for the international company come to China, you really actually have to think about it. What's your edge? And actually how to really change the way you do business in your home country, and to make sure you really localize your product and services to be competitive in China.
I'm going to come back on demographics in a minute, but Neil, I'm going to put you on the spot for a second. The most interesting next in China investment space that you're looking at or thinking about?
Well, I think information technology continues to be very exciting. Obviously, healthcare is also a very big area for us. In the information technology area, we do observe a shift gradually from consumer internet to more and more today enterprises, and obviously including big data, SaaS, AI, type of applications. Well, the last 15 years, if you talk about so-called new economy in China, is all about consumer internet. Whether it's BAT, JD, or Xiaomi, right? It's rightfully so. If you look at US, again, the big portion of the internet innovation are in the consumer internet. But if you look at Silicon Valley, half the market cap probably created from so-called enterprise applications. And I think China is getting to a point that the corporates is looking for different ways, especially technology tools to increase the efficiency and to compete effectively with their peers. And with the rising labor cost, they have to cut down the cost, and all those has leads to probably more attention and more resources put into information technology tools in the software areas.
If you want to ask a question, just wave your hand or grab the mic here. And okay, one sec. I want to address quickly first the demographic question, because one of the things that snuck up on us, if you look at India, India has a youth bulge. They're generating 1 million 18-year-olds per month, which is a lot. And that's going to continue for another 20, 30 years. China has more people leaving the workforce than entering the workforce today. And in 5 years, there could be labor shortages. And it's kind of beyond me, why we don't see the government more accelerate to drive the savings rate down by, giving a social net. But let's just address that and then just quickly, Jing, and then just go to questions,
So
okay?
you mentioned the comparison between China and India. Every year, China has 14 million babies being born. India has 25 million.
Right.
As you know, China just removed the one-child policy. That policy had been in place since 1972. I was born before that in China, so I'm lucky to have a younger sister. But it's been in place for over 40 years. So therefore, you have an aging population. The leadership hopes with the removal of the one-child policy, China's birth rates could go from 14 million babies to 16, 17 million. However, I think they will be proven too optimistic. So I think these days, with demographics in China, we've passed the point of no return. The number of women of childbearing age is shrinking. So there's no way China's birth rate could grow exponentially. So the challenge for China is to provide for the old. The challenge for India is to educate the young. In the very near future, the India population will actually exceed that of China, will surpass that of China. But in China, the problem is the aging population, the so-called inverted pyramid. So you have one child growing up to support 2 parents and 4 grandparents, and this is not a sustainable model. And the pension system is largely unfunded or underfunded. The social welfare system is not in place. There's no healthcare system to provide for the elderly and the sick. So what is going to happen? And on top of that, as you mentioned, Tim, the workforce is shrinking. So robots in China will be a great area to invest in. And if you talk to companies that are involved in robotics, ABB, lots of Japanese companies, etc., they will tell you that the fastest growing area in robotics is actually China. Across manufacturing industries. And the other challenge for the Chinese leadership in the service area is to really introduce an adequate social welfare system, including pension, including healthcare and education. And this is still very much lacking. And I would argue this is a big impediment to China's growth as a consumer society because people save too much. They save 40% of their income because they have to save all that money to provide for themselves when they grow old, when they retire.
So we have about 5 minutes left, and there look like a lot of questions. So let's go to the Q&A, and just maybe keep your questions as short as possible, please.
My name is Ping. I'm a consultant for large pensions. So I think just 2 very quick questions. One's on the...
One question, quick.
The question would be, so for the new economy, I noticed that there are, in many cases, a lack of regulation, at least at the beginning, to kind of level the playing field. And from your perspective, as an investor, how do you kind of deal with that kind of situation?
Neil?
Well, I think it's I think probably a natural process for any industry to go through. Internet finance, for example, I think initially there are a lot of entrepreneurs starting different models. You call it P2P, online payment, and over the time that when those companies grow big, I think the PBOC starting to take notice and starting to come up with different rules and regulations. I think this is a very natural ways, and I don't see this different from any other countries. And a lot of innovation really have coming from grassroots, and obviously it's getting to scale. Then I think it's the right time to probably looking at how to regulate it and to putting things into more sort of a more a proper order in terms of regulations.
Okay. Question? Right here.
Is this on? Yeah.
Yep.
So you started by saying that China is not even an emerging economy. Let's not use that word. We're talking about old economy, new economy. But the reality is China is probably one of the most uneven economies in the world, and it's still a very poor country.
Gini coefficient, yeah.
Huge.
Yeah.
46% of the population lives on $8 a day. So we're talking about all these potential changing into a consumption-led economy, but you correctly point out there's no social safety net. They don't even have enough water. So to me, one of the biggest risks is the social unrest, and of course that leads into the political. So can you address the political?
Look, there's no guarantee that economic development has to be something that's made available equally to everyone at the same point in time. China has taken more people out of poverty in the last 25 years than the rest of the world combined. You're entirely right. There's still a significant disparity between rural and urban China. China's moving, the urban share of the population is 56%, probably headed to 70%. That will address a lot of, between now and say 2030, that will address a lot, but not all, of the income inequality. This is a problem that's global in scope. I dare say there's a pretty significant problem of that in the United States as well. But, you know, we're developed. China is still developing in providing more opportunities for its poor rural population.
Question? Right here.
Just to summarize what I've been hearing for an hour, we can leave the session safe in the belief that everything is hunky-dory in China. The sky is not falling. There will be some bumps along the way, but it's got enough bandwidth and tools to throw at the problem. Is that a reasonable summary?
Great job.
Well done.
Great job.
Next question. Let's go to the back a little bit. So anyway, we'll go to the back after this question, okay?
Quick question. New economy, modern economy, third economy, transition to consumption-based economy implies by definition that you have a more open society. Is that compatible with all the restrictions that have been imposed by the new leadership?
Who wants to take that?
No. I mean, it's a fair point, especially the recent law that was just passed to sharply restrict the operating behavior of NGOs, which has a lot of us concerned. The internet censorship issue is another one. The question you raised, though, is that the impediment to the new economy? And I would say the answer to that is no. That doesn't mean we have to approve and support these initiatives.
Since we were summarized and wrapped up already by the other question, we'll have one more question over here and then finish up.
Chinese say, we say, if you want 1 year of growth, grow grain. And if you want 10 years of growth, grow trees. And if you want 100 years of growth, grow people. Given what was discussed in this panel, do you think it's still going in the same direction? And I think the most important point what Jing mentioned, when everyone was worried China GDP growth in terms of percentage was going down, coming from 2 trillion today with 10 trillion, the incremental delta is still growing. So are we heading in the same direction for the next?
Well, growth rate will moderate, right? We all know that. But because of the sheer size of the economy, I think we need to look at it on a per capita basis. China's per capita income is only $8,000 US, 20% of where the US is today. However, some cities like Beijing and Shanghai already have a per capita income of $15,000 US. Therefore, they've reached middle income country status. So the Chinese leadership has pledged in the next 5 years, between 2010 and 2020, to double per capita income. So if you think about it, Shanghai, all of you I'm sure have been to Shanghai. Shanghai is a very prosperous city. So if the Chinese leadership goals are to be achieved by 2020, the rest of China's income will double to Shanghai levels. Can you imagine 5 years, 6 years from now, the rest of China will all look like Shanghai? So that's the optimistic outlook that we can kind of look forward to, I suppose. But importantly, you know, we can say China's emerging market, but on a per capita basis, China still only ranks number 90 in the world. So there's still a long way to go, and I don't think China will fall into the middle income trap. As we said earlier, the leadership does have the ambition, the wherewithal, and the political determination to deliver on its growth objectives.
I want to wrap up here. We're a little over time, and thank you all for joining us today as opposed to Kobe Bryant. And we appreciate the panelists' work today, so thank you. Thank you, Stephen. Michelle.